Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Paul Krogdahl and Ville Sointu. This is Fintech Daydreaming.
We're back. It's fantastic to be back again. It is a new year, a new season of the podcast. We are absolutely convinced that we're going to do even better this year than we did last year. Ville and I have pulled out no stops. We are looking for some fantastic guests like we have today. And we really want to push the boundaries on the discussions around the disruptions that are happening in the banking industry, looking at the continued growth of fintechs and all of the fantastic things that are changing and happening at the moment, everything from metaverse to blockchain to cryptocurrencies and whatever else we think is going to be exploding this year. But as always, welcome back to another episode. I'm Paul Krogdahl. My name has not changed. It probably never will change. So I'm still Paul Krogdahl. And with me, as always, I've got my fantastic partner in fintech and good friend, Ville. How are you, Ville? How's Christmas been?
I'm good, Paul. And Christmas was really good. New Year's was even better. And I'm really excited about season 5. I mean, 2022 is looking really exciting. And again, I think we have a fantastic start to season 5 today.
Yeah, of course we do. Because with us, we've got none other than Ron Shevlin, who is, I am sure, known to absolutely everybody who moves in the circles that we move in around fintech, banking. I mean, not only is he a chief research officer at Cornerstone Advisors, he is an author at Forbes. He has written a book named Smarter Bank, and he's seen as one of the global influencers in this space and a keynote speaker. But I mean, I cannot do justice in this. So Ron, why don't you share with our listeners a little bit about the background of Ron and how he ended up being this fantastic influencer in the banking industry?
I guess it all comes down to having married the right woman, because I have to give her all the credit. So let's do that. But I've been basically in consulting now for a long time. I was with KPMG, a unit called Nolan Norton, doing a lot of IT strategy work in the 90s and then 2000s with a company called Symmetrics. And then having tired of being on the road all the time, I ended up at Forrester Research, which put me into the analyst world. And for all intents and purposes, I've been an industry analyst now for about 25 years. I spent 9 years at Forrester, 7 years at IT Group, and then I left coming up on 7 years now to help Cornerstone start and grow a research practice. And so that's how it stands.
So I have to ask, how do you become an author for Forbes? I mean, that's a cool, interesting one.
Yeah, so the funny thing was at the end of 2018, December of 2018, I got a call from some guy who said that he's the editor of the Forbes Money section and said, would you like to be a Forbes contributor? And it took me all of about a millionth of a second to say, yes, I would. Yeah. And then, went and told my wife, hey, guess what? I just got asked to be a Forbes contributor. And she said, how does he know of you? And I said, I don't know. I didn't ask. So I don't know. Somehow they must have read what, I've been blogging now since 2006. I had started a blog called Snarketing, had moved it to thefinancialbrand.com. So somebody might have recommended me. He might have seen it. But the funny thing is, 3 years now, I've never gone back and asked him how he found out about me. I just accepted it and ran with it.
No, I'm absolutely enjoying and loving following you on LinkedIn and also reading your articles on Forbes.
Thanks.
And I have to admit that you are one of the people, along with a number of others, that have really influenced my circle on LinkedIn and a lot of my points of views as I have sort of progressed in my career with inside of banking, again as a consultant, very much like you.
Thanks.
But with that in mind, I mean, one of the things that you're focused on is the wider sort of influential base of fintechs, disruption in the banking industry. An awful lot of the work that you're doing is writing articles around what we're seeing happening going forwards. Based on that, if we take the sort of big picture, not technology, but more of business trends, what do you think are going to be the big 3 to 5 focus areas or trends that we're going to see in the banking industry during 2022?
Yeah, thanks for asking, Paul and Ville. I appreciate this opportunity to kind of share some ideas with you guys and your listeners out there and your viewers. But you know, what's funny is the list grows every year, and this year it's growing even wider. It's just kind of amazing that the list of issues and challenges facing the industry, while they change from year to year, it's getting bigger and broader. And for better or worse, one of the top issues and challenges facing the industry this year has absolutely nothing to do with technology and really nothing to do with the business environment per se, or the economic environment, I should say, but everything to do with talent and staffing. The Great Resignation has not necessarily hit banking to the extent it has hit other industries, but the challenge for the industry, the financial services industry as a whole, to find good talent, especially locally, has become a challenge for a lot of companies. And it is really at the top of the list. You know, I do an annual survey every year called What's Going On in Banking, where I ask financial services executives, you know, what are the top issues and challenges and priorities you have for the year? And talent has never been towards the top of the list, but was actually at the absolute top of the list this year. And, you know, there's a couple sides of the coin to this too. It's not just a challenge for the banks and credit unions and the traditional financial services firms, but is increasingly becoming a challenge for the fintech startups as well. They've always had a better chance of finding younger talent and technical talent than the traditional firms, but even they are finding that it's becoming a challenge. So that is certainly at the top of the list of issues and challenges. From a more industry kind of perspective, there are, I think, a couple things that are, you know, really starting to heat up. None of these are going to be, you know, eye-opening or revelations for anybody listening in, but they're starting to really dig in. And a couple things, especially around embedded finance. Yeah. And the provisioning of financial services by non-traditional financial providers. My colleagues and I just finished up a survey of consumers asking about their interest in embedded finance, and especially among creators, you know, people who are looking to make money on TikTok and YouTube, and especially among gig workers and small businesses. There's a huge amount of interest in doing business with non-traditional providers because of the advantages of, you know, having financial services embedded into the other services that they get. So that is clearly getting a lot of traction. And of course, we can't overlook the influence and trending of cryptocurrencies, in particular Bitcoin, of course. But, you know, I think more importantly, things like Ethereum and how it's driving Web3 or decentralized finance and so forth. You had mentioned the metaverse. I would put that on the back burner for 2022. It'll certainly drive a lot of attention and articles, but in terms of real impact, I don't think we're quite there yet for 2022. And I don't even think 2023 and maybe even 24 before we really start to see the impact of that. But I do think that the whole decentralized finance movement, which I think is a real misnomer, by the way. It's not truly decentralized. It's really more about driving things off of cryptocurrency, blockchain, Ethereum in particular. Maybe there'd be something else that would replace that, but it seems to be getting a lot of traction. And the developer community in that space is growing by leaps and bounds. And so that's really, I think, what's at the top of the list for 2022: staffing, embedded finance, and decentralized crypto, the convergence of crypto, Ethereum, decentralized finance, and as Web3 really starts to become a reality.
Fantastic. I'd like to revisit back on that list that you had there, starting again right at the beginning with, skills and finding the right labor, resources, etc. Do you think that's predominantly in the area of technology or in, general banking industry, or is it in the understanding of the transition towards more of a platform business model? Or how would you break that down? I mean, this is a great opportunity to let some of our listeners understand what are the skill sets that they should be focusing on to give themselves a good position in the banking industry going forwards.
Yeah, so certainly at the top of the list are technical and technology skills. But let's get even more specific than that. It's not just coding skills. No. It's really, I think, at the intersection of business and technology. It's integration capabilities. It's technology business design. It is understanding the impact of new business models and how technology enables that. That's been a challenge for a lot of financial services firms. Many, of course, in the US below the top 10 or 15 rely very heavily on vendors for their technology, and to a large extent kind of outsource it. It's not a true outsourcing, but you think about it, they rely so heavily on third parties that they don't have huge technology staffs. But I think they're learning that they need to have a staff has skilled in integration, and in particular APIs, API development, API management, API deployment. And to a large extent, that's not just strictly a technology skill. There has to be some business design and business knowledge in it. But there's also the need for a lot of really kind of strategists. I mean, clearly, they're not looking for tellers in the branch. I mean, that's not, although I can, as soon as I said that, I opened my mouth and said that, I heard a bunch of my clients going, no, Ron, we need those skills too, and they have to be good, and they make a good point about that. But, it's about having a lot of strategists, or more strategists, I should say, and that's becoming a challenge for the banking side of the coin for sure.
Now, Paul mentioned that, of course, that what types of talents would you need to have in order to become part of the fintech industry, especially on the bank side of things. But turning that around a little bit, now I work for a bank myself, and I'm of course curious to hear your opinion on, do you think banks need to change as a place to work, and how, in order to attract this talent? Because obviously the talent we're talking about here is in high demand all over the place.
Yeah, I really you make a great point. And it's one of those things that has frustrated me for years about how sort of short-sighted banks have been. They let fintech steal their value proposition. Look, you go to most mid-sized towns in the US and probably in other countries as well, and ask, who is it that lent you money and supported and helped you grow your business? And they'll say, it was my community banker. It was my community bank. Who was it that really funded the small business growth in many countries? It was the traditional banking world. But they let that value proposition sort of be taken away by fintechs who came in and said, oh, we're all about involvement into finances and supporting people and inclusion. It was like, well, wait a second, that's what the banks have been doing for years, and they let that value proposition slip away to the point where, now they're trying to claw it back to a certain extent, but I think the cat's kind of out of the bag. So, Ville, I do think you're making a great point there, and I think to a large extent the banks have kind of lost, and then banks and credit unions for sure, have kind of lost that positioning as being the supporters, the funders, the growers of small business, and helping people, meet their dreams through, mortgages and things like that. I think they've kind of missed that boat, and I think they're doing it more so than the fintechs are. But the fintechs have stolen and grabbed that value proposition.
There's an interesting sort of dichotomy here between what you were saying, Ville, and also what you're saying, Ron, right? A lot of banks have, for a number of years, been running around with this whole notion of we're a technology company with a banking license. At the same time, we're seeing banks more and more saying that they need to move towards a as-a-service paradigm, outsource as much of the IT as possible. And now we're saying that we need to increase IT availability or IT knowledge within inside of the bank. So what does the bank organization look like in the future? Is it an IT company? Is it a very slim bank with outsourced IT, or how do we think this is going to look?
Yeah, I think there's a progression here. First of all, I absolutely despise with a passion that line, we're a technology company with a banking license. And if I ever hear a client say that, I'll generally respond. I go, oh, you mean you like to break things and you know, flout and have lousy customer service? It's a nonsense type of thing. And you know, the flip side of it, there's a growing meme out there that, and I think it was started by somebody at Andreessen Horowitz, that every company is becoming a fintech company. That's another bunch of nonsense, guys. It's like saying, well, every company is a cleaning company because they empty the trash every night. They don't. They outsource it, and somebody else is providing it. So both ends of the spectrum are absolutely wrong. But the evolution from the banking organization itself, I think goes from kind of where it is today, where it's sort of like, oh yes, you know, we're a technology company with a banking license, to we're a risk management company. It's really, that's sort of the core capability is risk management, risk underwriting, and recognizing that, you know what, there's going to be a lot of players out there who have money and want to lend money, but need to have the underwriting and risk management capabilities that a bank has developed over many years, and to, you know, quit fighting for that market share of the loan itself and monetize the capability. Yeah. And then I think that evolves to a true kind of money management capability. You know, I appreciate you mentioning the book I wrote, Smarter Bank. The subtitle of that book was Why Money Management is More Important Than Money Movement. Yeah. And the banking industry has really has seen itself over years as a money movement mechanism, whether that money movement is through payments or through loans. And I think that evolves kind of up the food chain to a, you know, almost like a, you know, what's that pyramid of, like, you know, your self-actualization at the top. Who was the guy that came up with that? I'm blanking out of the name of that, you know, that pyramid. Was that
Maslow's hierarchy?
Maslow's hierarchy. Thank you. Thank you. It's too early in the morning for me to get the brain going here. So I appreciate you guys jumping in on that. So there's kind of a Maslow's hierarchy in banking as well, where, you know, security is at the bottom level. And we've kind of, while there are technologies that are changing and helping improve that, that's been in place for many years. Money movement's kind of in the middle, but money management and money optimization, whether we're talking at the consumer level, at the small business level, and even at the large corporate level, is really where the opportunity is. And so banks need to recognize that they have to kind of move up the value chain a little bit. You know, let me give you a parallel of this. Go back to the you know, late 80s, mid 80s even, and look at how Microsoft evolved. You know, Microsoft started off as an operating system, DOS, and then started moving up to the next layer of the hierarchy, which were business applications like you know, Excel and Word and things like that. And tried and have continued to try to move up that hierarchy and value chain into MSN and Sidewalk and other capabilities in consulting. And so, you know, they've recognized from the start that you can't, you know, to really extract value out of the chain, you've got to move up this hierarchy. And I think banks have to recognize too, is that you can't just make money at money movement. From a payments perspective, not just because of the economics, but also because of the regulatory aspects of this. You know, anybody who's betting their business model on interchange for the long run is crazy. You mean, you're just crazy to bet your business on interchange. It's, you know, too risky. The rug can get pulled out from you at any point in time. And so where are you going to, you know, extract value? It's through money management, money optimization. And I think the banks have to sort of recognize that they have to build towards that and create a skill set and capability and competency that builds on money movement, builds on risk management to money management, money optimization.
I'd like to you lined me up very nicely there to the second point that you highlighted as a key trend for 2022, which was embedded finance, right? Now exactly what you just said there about moving up through that stack for the banks and looking at embedded finance. A lot of banks are worried that embedded finance is going to turn them into a commodity-based business. But what's your view on that?
A couple of things. Number one, I actually wrote this recently, and I said, everybody's worried about being dumb pipes, right? Well, here was my take: is if you can make a lot of money being a dumb pipe, all the more power to you. You don't have to fight, and if the margins are there, take it. It's great. I think a lot of banks are short-sighted on the embedded finance. They kind of believe it's a threat to them, but they have the benefit of regulatory protection on this. You can't, as a non-bank, just go out there and provide banking services and lending services and all these payment services. And so for many banks, it's actually a huge opportunity. But culturally, you have to get past the idea that you're the brand in front of the customer. It's okay if your customer is somebody else who deals with the end customer. And I think there are a lot of smart banks out there. Vast Bank out of Utah, comes to mind. Coastal Community Bank, another. So there's a number of growing banks that are recognizing that, hey, we don't have to be the relationship holder to the end customer. Our relationship can be that provider of services. And it enables them, if you think about it, to expand their business much faster and wider than they ever could on their own. And so it's a huge business opportunity. I've got a report that'll be coming out probably in the beginning of February, where I've sized the opportunity for banks, and I'm estimating that this is a $50 billion opportunity for banks. It's about could be around $50 million per bank, and that's a nice chunk of change to replace a lot of the lost overdraft fees that we're going to see over the next couple of years. It's a big opportunity, but the banks culturally see it as a threat, as a whole, and I think that's really short-sighted.
So, the whole idea of embedded finance, along with open banking, the whole platformification of the banking industry, it's all heading in that sort of direction. Does that mean that the metrics, the business metrics, the revenue metrics, et cetera, that the banks have to measure themselves against have to change as well, do you believe?
Well, I'm not even sure if the metrics have to change, guys, as much as the culture and the perspective changes. It's the idea that you don't necessarily have to have the relationship with the end customer in order to be providing value and making money in the industry. If there are going to be intermediaries, and it makes a lot of sense from the consumer or customer perspective, whether that customer is a consumer or a small business or creator or gig worker, whatever it might be, if it makes more sense for them to get a financial service from providers of other services to them, then that's just a distribution channel problem or challenge or opportunity. But I really find that there's a lot of bankers who don't see it that way. They just can't get that this is simply a new distribution channel. And what I also try to do for a lot of banks is try to put it in a historic perspective. Think about how the concept of distribution channel has changed and shifted over the years. For too many bankers, because they're generally of a certain age, they're stuck in the branch as distribution model, distribution channel model. But it's going back at least 20 years now, closer to 25, where the internet became the new distribution channel. But it wasn't just the bank's website. What it evolved to was search. Google was the new emerging distribution channel, and it gave birth to the whole search engine optimization industry. And banks had to learn how to distribute their, not just the product through Google or anything, but distribution in terms of how to gain market awareness and customer acquisition. What's happening is now is the platforms have been merged as the new distribution channel. And now it's becoming where the intermediaries, who aren't per se platforms, but so many different providers of various types of services to various niche groups in the market, are becoming the new distribution channel. So it's important for the bank to understand a couple of things, not just what's happening from an embedded finance perspective, but figuring out who do they best serve. What types of customers, whether it's small business, gig workers, general consumers, segments of the consumer market itself, and figure out who are the potential embedded finance providers that serve those markets well, because that's how they compete. And so give some credit here to a company like Green Dot that has, through its prepaid debit cards over the years, really started to understand and understand the needs and how to serve the low to middle income consumer market. So as they progressed, they sought out the intermediaries like Walmart and others who serve that market because it was a win-win situation. They helped their partners, the embedded finance providers, how to best reach those consumers with the financial products. And there was a win-win. So there's an example of, the path that the banks need to go on as well is really kind of first looking back. Who is it that we're really good at serving? And I think that part of the challenge for a lot of community banks in particular, and certainly for the regionals and larger, where they don't have those natural affinities. I always like to use the example of LA Police Federal Credit Union out in California. These guys know how to serve the law enforcement community. They work with them every day. Their members are law enforcement. They design products and services. Their challenge is, how do we take this beyond just the borders of California and in the LA region? But for many community banks, they don't have that natural affinity of customer base, and so they're a bit more challenged to figure out, okay, what's our growth strategy?
On the notion of being a dumb pipe, now anybody who has ever had to call a professional plumber knows that there's a lot of money to be made in plumbing, for sure. So I don't see anything wrong in that. And for sure, we've seen the same happen in the telecom industry as well. I remember when 3G was a new thing, all of the mobile operators were obsessed about building all these value-added services in order not to just become a dumb pipe. Now, we all seen the telecom industry transform, and indeed, many of them are dumb pipes, but there are also much, much more. They have practically reinvented the business model not to rely on these services. But one point I wanted to make is that many times when banks have these conversations about the strategy, the channel strategy, about the embedded finance, one of the things that keeps on popping up is that if we do become just an API, basically embedded in other customers' workflows, then aren't we missing out on a lot of the data which everybody is telling is so important for banks? Because if we just get an API call, a request response, then we don't know necessarily what's going on within the transaction other than the payment information, for example. So do you see this as a valid problem for banks being left out of the data equation?
It absolutely is, but it goes back to figuring out where in this value chain of service provisioning do you really fit. You may not be the holder or creator of the data, but realities, and you started your comment off, Ville, with the comment about being the plumbers and being the dumb pipe. I think the reality is that the concept of the dumb pipe kind of goes away. You don't survive as a dumb pipe, you survive as a smart pipe. And the smart pipe means that you might not have the data, but you facilitate the transmission and utilization of data. I mean, the data is, there's a two-sided coin here. One is, do you have the data? And the other side is, do you know what to do with it? And I guess there's probably a third, which is getting the data to where it needs to be. And so it isn't so much, gee, how do we use data to personalize and do that? Somebody else is going to do the personalization, perhaps, the embedded finance provider, the platform itself. But the bank has to be involved, leveraging its capabilities and competencies to say, here's the data we need. Here's the data you need. Here's what to do with it. Here's, if it is about being a pipe, we're going to get that data out to where you need it to be. As being the API provider, it's not just about making the connection. It's also about the utilization and deployment of that data. So again, and I'd be hard pressed to give you many examples of banks who are particularly good at this today. It tends to be the larger platforms who are building competency around that. But even, Google recognizes, and I just saw an interview, I think it was, forgot where it was, maybe Financial Brand, with Zach Mouth, who runs the group. And he's basically saying, look, we might have gotten out of the Plex product, but we're still committed to, seeing banks as customers of ours and helping them with their, businesses. So, turning around, it's actually the platforms who are looking to help the banks make better use of data. And so we're not, it's hard to kind of envision how all the components of the future industry kind of get put together. So things kind of getting thrown up, and we're thrown up in the air, and we're kind of seeing where it all lands, I guess.
And I suppose also from an embedded finance perspective, majority of the capabilities or products that will be implemented in an embedded finance type use case are going to be the low-hanging fruit ones, the simple products like payments, simple loans, etc. I mean, a common friend of us in his recent book, Paolo Cerroni, has the very good quadrant where he talks about from your loans all the way up to insurance, and the fact that the banks should be looking at moving up towards a sort of more value-based, conscious models rather than exactly that book. Yes. So I suppose there is a sort of double, I won't call it a double-edged sword here, but there is, the embedded finance does become to a certain degree a commodity-based play, but a positive one for the banks, whilst they continue focusing in on these more, top right-hand corner products and services that Paolo talks about in his book.
Yes, absolutely. It's not a threat. It's an opportunity. It is a the embedded providers become distribution channels for the banks. There's two challenges though from the bank perspective. One is figuring out who do they work with, which ones are best suited for them. But there is a technology challenge. They have to be well integrated. And most banks just don't have those capabilities. Some of the earlier providers have built them internally, but I think what's really exciting is there is a growing set of technology companies that are emerging to help the banks capitalize in this opportunity. Companies like Synctera and Item and Treasury Prime come to mind. Move, I would throw into that mix as well. And so they're kind of the new technology infrastructure players, although I would call them, BaaS infrastructure players. And so, they're filling that gap that the banks have in not having the technology capabilities. But over time, just as banks wrestled with relying on FIS and Fiserv and Jack Henry for their core infrastructure and core systems, many banks are going to wrestle with the economics of having BaaS infrastructure providers cut into their margins as well. So it's a business model problem, but it starts with a strategic view and of the market and where the opportunities are, and to a large extent cultural challenges in terms of where do we want to play in the scheme of this infrastructure.
Yeah. You mentioned technologies. I'd like to flip a little bit here, go back to predictions and look at 2022. What do we think are going to be the sort of top 3 to 5 technologies that the banks are going to be focusing in on this year?
The same ones they've been focusing in on for the past 5 years. This is the problem with the banks, I think. If you're looking at this now from the banking perspective, the digital account opening remains the top technology that banks plan to make investments in. And I think it's been that way for the 5 or 6 years that I've been doing this what's going on in banking study. Also at the top of the list, are things like APIs and cloud computing, But this year as well, what would really encourage me in what's coming up in the new report that I'll be publishing in a week or so was that chatbots have finally kind of cracked the list of the top 5 investments. We've been hearing the predictions of AI and the transformation of banking through AI for a number of years now, but it's never really cracked the investment list. And it finally has, started to, really find its way into more of the mainstream, both from a chatbots and machine learning perspective. And I think that has a lot to do with the vendor community who's finally integrating and embedding those capabilities into their offerings as well. But that's kind of cracked the list. And it may not be in the top 5, but CRM is out there once again, as a top technology that the banks want to invest in. And because we're at an economic cycle where deposits are high and lending is a challenge, digital loan origination systems is in the top 5 list again this year, and that tends to be more of a cyclical kind of a thing. But I had this argument, sort of an argument with Jim Marous, publisher of the Digital Banking Report and Financial Brand, a couple of days ago. Yeah. About digital account opening. And, my feeling was kind of like, let's get past this already, get it done, move on to more important things and quit jerking around with this stuff. His argument was, look, this is super important from a customer experience and customer acquisition perspective. And he makes a lot of good points, but I still kind of remain stuck in my view that we got to move on from digital account opening to other bigger problems.
Sitting on the other side of the fence, Ville, what's your perspective on this? What technologies do you think are going to be the hot potatoes this year?
I think the bottom line here is exactly what Ron said. It's going to be the same 5 as it was the past 5 years. Yeah. Things take time. The base technologies evolve for sure, but the banks need to be, again, conservative and execute on the ones that are on top of their list right now before moving on to figuring out whether they want to build a branch office in the metaverse or something, something exotic like that. Yeah. But and by the way, we had Jim as a guest roughly about a year ago, one of our most popular guests and episodes. So I really enjoyed the chat with Jim, and I encourage our listeners to go back and listen if you didn't get to hear it back then. But I want to circle back to one of the things on your list for predictions for 22, which was crypto. So the cryptocurrencies obviously is a very popular topic as well here on our podcast. And I couldn't help but notice, I read your Forbes articles quite keenly myself, and you were talking about banks going into crypto. And there was one sentence that really caught my eye, which was that the banks are finding excuses not to go into crypto, and yet they also have good reasons why not to go to crypto. But I was curious, can you list maybe some of those top 3 excuses and reasons for banks not being in crypto, and how do you think this is going to play out in 2022?
Yeah, one of the common excuses we hear and that I hear has a lot to do with the volatility of crypto in general, and the argument that why would we enable our customers or our members to make investments in this when they could lose 60% of the value overnight. To which I pull out statistics and show, well, here's 3 stocks on the New York Stock Exchange that lost 60% of its value in the last year. And I don't see you stopping your customers from purchasing that stock. So that excuse doesn't work. Then they go to the regulatory excuses, and those are falling fast. Even I think it was NCUA came out, supported this. Then they have the integration excuses. And I don't think we can underplay, at least from a US perspective, the importance of NYDIG's partnerships with practically all of the top core system providers. I think within literally a couple of weeks, they had deals with FIS, Fiserv, and Jack Henry announced, and I believe they've expanded that. I think CSI is in that list now as well, a couple others. And so then they go into the, well, is this, really a trend? Is this just another tulip mania kind of a thing? Or is this really, something that's going to persist? And, I think there's still a good question of whether or not Bitcoin itself becomes a currency of choice, but as more and more people are looking to make payments with crypto and Bitcoin in particular, it's gaining some traction. But if you look and go back to our earlier discussion about decentralized finance and Web3 and the role of Ethereum, it's really getting hard for these banks and credit unions to kind of, stay away from this and rely on these excuses. And I also like to pull out the consumer data I have that says that, when I last looked, and I'm going to be updating this shortly in a new survey, but last time I looked, which was actually at the end of 2020, so it's been a little over a year now since I actually asked this question, but at the end of 2020, about 15% of Americans said they held some form of cryptocurrency. I would expect during last year that number increased a significant percent. But of those people, I asked, if your bank offered cryptocurrency services, how likely would you be to get it from them? And it was a very large percentage of those existing cryptocurrency holders who want the services from their bank. They trust their banks to do this. They want it integrated in with the rest of their holdings. They want more mobility and agility with those holdings, and they see it from the bank perspective. So my take to the banks is always, you guys sit there and tell me how customer-centric you are. And here we are. I show you the data that this is what your customers want, and you're finding every excuse in the book to ignore it. And in the What's Going On survey that I just conducted, I've got to say, and I wrote this in the Forbes article, it's still a pretty small percentage of banks and credit unions who said that they'll launch crypto investing services in 2022. And this might be one of those predictions that I'll get very wrong when we talk again this time next year. But I think we're going to see an acceleration of that number as more and more banks jump on this bandwagon. And you guys know how the banking world works. It's very much gee, if everybody else is doing it, we better, it's the FOMO problem. We don't want to get left holding the bag here, being the last one, not providing these services. So I think that number is going to accelerate a bit more. And I think the excuses that they offer for holding out are falling by the wayside.
No, go on, Ville.
Yeah, no, I was about to say that I'm myself, of course, a little bit on the fence on this topic. I think there are still good reasons why banks are finding it hard to enter this space, and I've been on both ends of the spectrum with my opinion for a long time. But at the moment, I'm squarely in the middle of seeing how it's going to play out. I think the utility question is valid still. It's very hard to find good utility for any of the cryptocurrencies, or that's it, most of the cryptocurrencies that we're seeing out there. And therefore you're hearing jokes like, well, can you actually pay for anything with cryptocurrencies? And the answer is yes. All you need to do is to exchange it to US dollars. So that's kind of the bottom line for me when it comes to this utility of cryptocurrencies, and I think it's a key question for banks as well. Yeah. Is there really any underlying value for these crypto assets? But yeah, I agree to a lot of your points there on the excuses.
I think most of the banks are taking the perspective that crypto is an asset rather than a currency, right? So therefore, they're enabling their clients, or the banks that are starting to support cryptocurrencies are enabling their clients to invest in crypto rather than having it as an alternative means for buying their milk or bread, right? I always make the joke that if you were to go and buy bread and milk in your supermarket with Bitcoin, the price that it was listed at on the shelf is going to be completely different than what it is when you actually go and check out. So it's too volatile, like you said, to be able to be a relevant and good currency for general purchasing of small goods.
True, but I would throw one more angle in there that there's, I think, a third point on the triangle, not just asset or payment mechanism, but I would point to like Quantic Bank in New York that offers crypto and Bitcoin, I think in particular, as a reward. You get your reward points for payments on your debit card in Bitcoin. And so, yes, that's kind of the asset, but it's a way of kind of tying in Bitcoin into the traditional deposit product. And I think that's becoming more and more appealing to many consumers.
Yeah, no, fantastic. I also, you released a little report a couple of weeks ago. Just make sure I get the name here right. It was the definitive guide to potential misunderstood fintech trends and terms. Right, really good little paper. I actually think, looking on LinkedIn, you got an awful lot of positive feedback on that. What drove you to write that? I agree there's an awful lot of misunderstandings, but is it that complex, do you think?
Here's the genesis of that. That was a report commissioned by Nimbus Technology Company. They had commissioned us to write a series of reports. The first one we did last year on embedded fintech and embedded finance. And then, we're kind of fumbling around for, okay, what will be the topic for the second report? Yeah. And I was on the phone with somebody who actually had just joined Nimbus from Visa. And as we were talking about the report, and she was saying, using terms like embedded finance, embedded fintech, and banking as a service, I found myself saying, well, what do you mean by that? What do you mean when you use the term banking as a service? Or what do you mean by open banking? And I think that's when it just sort of dawned on me, wait, if we are having this conversation and trying to wrestle with the definition of terms, there's got to be a lot of other people out there who are wrestling with this as well. So I went back to Nimbus and said, hey, for the second report, why don't we're going to do a glossary of fintech terms. And it is not going to be your generic, here's the definition, two sentences, paragraph. It's going to be, Cornerstone bringing its perspective. Me and my colleague, Alex Johnson, who writes the Fintech Takes newsletter on Substack, we're going to bring our perspective to this. And, here's what we think it means, and here's the data to back it up. And so each of the topics we cover generally has anywhere from 2 to 4 pages in this glossary. But that was kind of the genesis of that, was let's put our stake in the ground of what these terms mean. We may be wrong. Hopefully Nimbus will want to commission version 2 next year, where we can update things like open banking and Web3 and decentralized finance. Because even since publication, I've read so many things that make me think, shoot, I should have included that, or boy, that really challenges what I was thinking there. So with some of these fast moving topics, but they bought into the idea that we should do this glossary just to kind of put a stake in the ground of what these things mean and what's the so what around them.
No, I took advantage of it actually last week on LinkedIn. There was the whole backlash last week of Starlin Bank, the founder of Starlin Bank, coming out with open banking as being a failure. Obviously misrepresenting open banking to a certain degree as a technology for account shifting. But I actually used the definition from your paper on open banking as part of my post on LinkedIn. So thank you for that. It was
sure.
Perfect. So Ron, what's next for you going forwards? Another book in the pipeline or something else interesting?
I don't see any books coming up. That's a large commitment of time. And, my business is doing commission research for technology companies. And man, I tell you, we're just busier than I've ever been in my career. So the beauty of it is, it's new topics every month and new stuff. I do think, though, a lot of the things that we've talked about today will rise to the top, because, the way this works is I'll get a technology vendor come to us and say, yeah, we want to commission a report on XYZ. And I go, oh, that's a great idea. But have you considered ABC or DEF, and, get them to focus on some of the hot topics. So the whole embedded finance, banking as a service, is going to be towards the top of the list of things we look at. The whole transformation and disruption of lending in particular is going to be up there as well. So yeah, we're busy as anything, doing a lot of commission research, looking at what's going on from a consumer perspective. And so no books, but, continuing to focus on some of these top trends and how the industry is changing.
I'm looking forward to that. I thought maybe just there was a current trend ongoing with Brett releasing his new book, and then Paolo, maybe you were going to follow with that, right?
Yeah, well, you know, the way I did that last book, Smarter Bank, was after having, you know, written 50 blog posts in the prior 2 to 3 years, I was able to take a lot of stuff I had already written and kind of reformed it into the semblance of a book. But right now, it'd be a huge time commitment, and I'll have to go back to my boss to see if they want to give me a little flexibility and leeway over the next couple of months. But I'm not holding my breath for that.
No, well, we've got all your fantastic articles on Forbes, etc. So definitely an awful lot of your thinking still coming across. So that's fantastic.
Thanks.
But unfortunately, we are running out of time, as is always the case. Great discussions, and before you know it, time has flown, and there's not much time left. So I was just wondering, before we close out, Ron, if people would like to follow up, have another discussion with you, get some more insights, etc., how do they best reach you?
There are a bunch of good places to reach me. Both best ways are through Twitter at R Shevlin, Shevlin. LinkedIn, just find me at Ron Shevlin, or ron.shevlin@gmail.com if you want to hit through email. Just don't call me, because I never answer the phone, as the person who called during this has found out the hard way. Yeah. Yeah, and I hope people will check out the Fintech Snark Tank on Forbes as well.
Yes, absolutely. We'll include a link to that in the text to this podcast episode. Apart from that, Ville, I'm conscious of the fact that we neglected a joke at the beginning. I don't know. Yep. Do you have a quick good but bad joke you want to throw in?
Well, at least it's a joke. Let's the audience determine whether it's a good or bad one. Did you hear that I got into problems with my compliance team again?
No. What did you do this time?
Yeah, I went and asked about money laundering. And I find it really confusing why I got into trouble, because I was just worried about the Omicron variant of COVID-19. I mean, the least I could do is to disinfect my money.
Yeah, that was bad. That was bad.
That was really bad.
And with that, we would like to say thank you again to Ron. We'd like to say thank you again to all of our fantastic listeners. I hope you've enjoyed this first installment of season 5. We've got much more to come, but as usual, please hit the like button if you've enjoyed listening to us yet again. And who could not have enjoyed this fantastic episode with Ron? Leave us a comment. Let us know what you think. Let us know what you would like us to cover. You know, the algorithms on the podcast channels like it when you leave a comment. So please leave a comment and promote everybody to follow us on YouTube. We want to get more followers on YouTube and get the algorithms up there as well. Ville and I will be back in 2 weeks' time with another fantastic guest. I believe we are looking at RegTech in the next episode, so that's going to be really cool. Until then, have a fantastic 2 weeks. We'll see you again in 2 weeks, and this has been Fintech Daydreaming.
This is Fintech Daydreaming.